All markets in panic mode. Bitcoin absolutely crashing. What's going on? Do we have a liquidity event or a black swan? So let's talk about it. First off, for the first time, we're seeing Bitcoin under 100,000. Just bounced back, but just short of 100,000, 99,000. So very interesting to see, and it just a sell-off event. Let's see what happens. However, it's pretty interesting to see. So whoever has followed our reports already knows that this could happen. So if you read our on-chain reports, so Cena just posted on X how we actually talked about the short-term volume, about the OG investors, so realizing profits rather than rebuilding positions. So the magnitude of the sell pressure is comparable to that of previous distribution waves observed in December 2023 and April 2024 and October 2024 and March of this year. So notably, this downtrend has yet to stabilize, suggesting that selling momentum may persist in the short term. In a healthier structure, would require LTH supply to flatten, marking a balance phase for consolidation. So until then, downward pressure is likely to suppress any sustained uptrend. And we had this published at our Bitcoin Intelligence Report. And by the way, if that's something that you would like to catch next time, since we've been pretty accurate on our on-chain analysis, so great work by the team here. So you can follow us on Substack on bitcoinintelligence.substack.com. All the links on the description below. But now let's go a little bit on the monetary mechanics part. So how the actual plumbing is also creating some turbulence for the time being, but also creating some great opportunities for the medium and longer term. But we always have to come back to this structure here. So the dollar, it's all about the dollar. The dollar has been making those moves that are creating some trouble, especially internationally. So, but whoever is seeing this image for the first time, so we do have a dual dollar system. We have the dollars inside of the U.S., which is the Fed regulated dollar system, and we have the euro dollar system, which are offshore dollars. And this is the most important part because the volume here on the euro dollar system it's much higher than the one within the US. Because of that position of the global reserve currency, it creates some tensions between those elements. And those are things that we actually track in order to understand what is happening to liquidity. Of course, we have many countries like China, Japan, that influence a lot what happens to the dollar based on what they do in their economies. So this is why we have so many counter currents. But let's discuss first a little bit of what's happening within the U.S. On a more of the regulated part, and it's all about repo. So everybody's talking about repo. And what is repo actually? So people are. Let me get back here. So many are just discussing how the Fed is printing billions of dollars every single day since the end of October, and this is just an injection. So many tweets just going around this word of the Fed injecting money to the banks. That means that we have a liquidity crisis, and all of a sudden everything is gonna it's going to be completely demolished here. So liquidity is not there anymore, and they need that backstop from the Fed. So this is not really what happens. So a repo facility, or what we call it SRF, the standard repo facility from the Fed, it's one of the escape valves for when you have some trouble in the markets, where we see how the collateralized rate, or what we call SOFR, which replaced the LIBOR rate, is something that is going up. So if it goes up a little too much compared to the higher limit of the Fed, then the Fed can provide those relief valves. However, it's very important to understand what happens here, because a repo transaction it's an in and out transaction. So most people just think it's the Fed with the big printer just injecting money on a QE style, and not even QE is money printing on that matter. But it's how it works. So basically, a repo is when you get collateral, so you present that collateral, mostly T-bills, mostly just U.S. bonds, and if you have a trouble finding a partner, another bank, for example, you can also do it with the Fed, where they get those bank reserves, which we call it, and you're able to sell to the Fed. But 24 hours later, up to 7 days later, you get that back plus interest, right? You need to pay interest on that back to the Fed, and you get your collateral back. So this is just a way for banks to have some matchmaking based on whatever dollar liability they have on that day that needs to be paid, because the dollar system is a credit-based system. So you create future demand on the bills you need to pay plus interest. So demand is always higher than supply. This is the dollar trap. This is why it's so difficult to understand. And here, so when you see the actual, let's say, a little bit of stress that we currently have. So this is the SOFR rate, which is the collateralized rate, and it's actually the main one for the euro dollar system, the offshore dollars, minus the Fed funds rate, which is, of course, what everybody knows, so the FOMC meetings that we have and the interest rate. So that delta is healthier when it's just lower, right, as close as possible. When we see those spikes, that's where it created all of the fuzz about a possible repo crisis or something that could break. But we need to take things into perspective, because if you check on what happened on the real repo crisis that we had in 2019, look at how big that is. You have to actually scroll for a while until you get there. See how dramatic it is. So basically a huge difference, a huge delta of almost 3%. This is absolutely huge. So the Fed wants to prevent that from happening again. That's why they put together that standard repo facility. However, everybody was getting concerned more and more because of the amounts that have been used on the Fed. So that means that if you need the Fed this much, it means something is broken, right? Something is collapsing. And we had all of those tweets all over the place about a repo Armageddon. But now we see that tension slowly fading out. So we see some evidence that it might be a temporary thing. Of course, nobody knows for sure. And on the other hand, the Fed is not really able to control everything that happens. You can have the SRF, but the problem is you have both systems. So you can help whoever has access to the Fed, but what about everybody else, right, that does not have that access? So this is a little bit of the black hole, so to speak. You don't know exactly what the problem is. You just know there is a little bit of a tension there, or more difficulty in sourcing dollars to serve your debt. So this is the U.S. part, and here on the euro dollar system, we track mostly what happens to SOFR, right? So this is why we see that tension between those two systems to understand what is happening. But even SOFR compared to Fed funds rate, even if we had a spike, now it is showing first signs. Let me try to see here. So it is slowly coming down. So let's see if that continues. But for now, we don't see a huge stress, but just some attention. But the real thing that catches a lot of our attention is the dollar. So if we go here to the DXY, which is the dollar index compared to other currencies, this really shows most of the stress. So now we did have a lot of the dollar force So coming down, especially after Liberation Day, where everybody would be trading out of the US. Now it's all about getting out of the US, getting out of the dollar and everything. But this everything that it meant is that people were getting more credit in US dollars. So the dollar system was actually expanding instead of contracting. And this is good for everybody because you have enough dollars for everybody to serve their own debt. The problem is the reversal. And we have been, so if you follow our reports, our videos, you know that we have been tracking since July 1st, which was the maybe a bottom here at 96.5, which was the weakest the dollar was for a while. Now we see it coming back over 100 again. So this is the problem. This creates some tension. This is just a barometer along with Bitcoin. So DXY and Bitcoin are great liquidity barometers to see what's currently happening. Does that mean that we're going to have any kind of liquidity event or crash? Today is way more it's way less about fundamentals and more just about panic, because we have the fear and greed index. If we check it out, by the way, it's a fear and greed index. You see how we are on an extreme fear right now. So you just see that FOMO or that sell event coming in can be a great opportunity. Of course, no investment advice here, but for sure we may see some correction on the other end as well, just a consolidation move, because the fundamentals have absolutely not changed at all. So we do have a lot of pressures that are positive on the other hand. So like the fiscal spending in the United States. So we talked about the negative forces. Now we can talk about the positive forces. So fiscal is something that is dominating a lot in the US. However, we did have a little bit of a pause, which might be as well as a temporary one, since we have seen the whole movement about the TGA. The US is just getting a lot of tax revenue from tariffs, but also we are in the middle of one of the longest shutdown periods ever. So we have had this accumulation about the TGA refill, as we said, after the ceiling, the debt ceiling raise. Which had a goal of bringing it back to $850 billion. That has been met already, but now we are overshooting to almost $1 trillion. So this is kind of a battery of liquidity that is not part of M2 or whatever you want to call it. This is completely outside of the market, but it will eventually be deployed back, and this will provide some more forces. So we have a little bit of a dampening going on the fiscal spending. So if we want to talk about the meme from Lynn Alden, nothing stops the strain. So the strain is a little bit on a pause now, a little bit of a temporary stop, because it just does not accumulate any not any further, but not too much further than that. So it's not needed. Also, we're going to see a lot of focus into a short-term debt of the U.S., which needs to be renewed as well. So that needs to be rolled, because that's how the U.S. is playing right now with the short-term debt, because they know exactly that this is exactly what the market demands. This is very liquidity positive, but you also need a lot of cash from the TGA to actually pay for those when they get to term, because they're very short, sometimes 4 weeks, 6 week, or 13-week T-bills, and you need cash to pay for those. So you have a little bit of a buildup, but once the system disperses, we can see liquidity coming back to play. So as soon as you have an institution that does not have enough dollars to serve for those bills, that's where you need to sell, right? To create that cash. But for sure, those movements are way too over. There's a lot of overreaction right now. It has nothing to do with that kind of liquidity. Actually, you don't you don't find too much of a correlation just because of that to explain a specific sell-off event. This is why it creates many opportunities, because all we talk about here on monetary mechanics is more for the medium and short and longer term, and not really all of those moves. But it's very important to see the outlook on what is happening right now. So I hope this information helps to see that fundamentals have not changed at all. I would actually be pretty bullish on what's been building in what comes to fiscal spending, stimulus, and the emission of T-bills, especially so short-term bonds in the U.S. And everything is very liquidity positive. But a lot of stress can happen in the meantime until we get there. All right. So I hope this information helps. See you in the next video.